basic overview. To hone the concepts learned on this module, please be sure to follow up this course with our quick and dirty basic leveraged buyout modeling and, of course, our complex leveraged buyout modeling course. This does currently assume that you have a basic understanding of accounting, fundamental concepts in finance and valuation, and we highly recommend prerequisites to this course include our accounting and financial statements integration, our Finance 101, and our corporate valuation courses at a bare minimum. Let's now turn our attention to the very first slide. What is a leveraged buyout? A leveraged buyout can be thought of through the following analogy. Leveraged buyout is simply using debt to buy something out, hence the word leverage and buyout. Now, you can akin this to the following analogy. Let's say you're buying a real estate property. Let's say you're buying a real estate property and the current owners of this property, let's say, currently have an 80% equity stake and they have yet to pay off the remaining 20% of the mortgage. You come in here and you borrow a massive amount of debt and you put down, let's say, anywhere between 10 to 20% to purchase this property, and you put down and you borrow anywhere between 80 to 90%. This is the leveraged buyout portion. Then you will use the internally generated cash flows. Key is the internally generated cash flows to pay down the debt and build equity. Build equity such that by the time you're done, your equity stake, not that this is drawn to scale, but pretend that there is no appreciation in the actual asset, but you will be able to build your equity up to the point using the internal cash flows generated to pay down the debt. And this allows you to now own a greater percentage of the company upon an exit or upon a sale. This is considered typically a financial transaction and usually sets the floor or the minimum valuation. Why is that? Because if a strategic buyer comes in theory, this is in theory now, they can also do the same thing and extract additional value if they're able to actually also provide economies of scale or cost savings or whatnot. Typically now, who is the private equity firm that is coming in? This is the person who is actually supplying the core capital, the equity base. Now, what is private equity? Think about private equities opposite the public equity market. What's the public equity market? That's simply the capital markets, the stock exchange, etc. So therefore, the private equity markets are basically sources of capital, sources of equity that are from private sources as opposed to the public, general John Doe investor, etc. Now, let's flip to the next slide. Leveraged buyouts basically provide a current market view of the range of hypothetical purchase prices by a third-party financial buyer. This is typically contingent upon several items. You must have an acceptable capital structure. You must have the right interest rate and return requirements for both the equity and the debt. We'll talk more about this a little bit. And also refinancing terms and whatnot. Typically speaking, and of course these targets will continuously change, especially as you meet different market trends in the current LBO cycle. But typically speaking, private equity firms like to generate at least a return of 25 to 30%. Here's a list of reasons why you might want to go private. Typically, LBO requires the buy-in of the management team. Hence, by the way, LBOs are sometimes considered MBOs for management buyouts because you absolutely need the management team to go there and run the company or bring in your own management team because you do not want to be running a portfolio company because you have, let's say, several of these portfolio companies. You're not going to be able to allocate the time that's required to run the day-to-day operations. Hence, the reason why the management team is absolutely critical. Let's go into several reasons why LBOs are done. First of all, the public markets are not properly rewarding a company's true or intrinsic value. In this case, for instance, during the dot-com internet bubble, the quality, quote-unquote, old economy stocks were ignored and punished unnecessarily. In that case there, you might see that a lot of these firms realizing there's a lot of internally generated cash flows, the valuations are depressed. We'll talk about the ideal LBO candidate in a second, and therefore the private equities might want to come in. Lack of a strategic fit with the parent company. A company may want to divest their non-core assets. Well, there's a perfect opportunity to do a leveraged buyout there and take it in-house within the management team. Similarly, there might be a lack of attention from the headquarters of the parent company, and therefore there's a little bit of disgruntledness, and that subsidiary might decide to say, listen, I want to get myself out and I can grow if I have the right resources. Hence, the parent company might decide to say, nope, don't want that, or it's not priority right now. Regulatory issues, antitrust dynamics. Many times you have consolidated entities in an M&A who might be forced to divest a part of the business so that they will not get too big, all due to antitrust dynamics. For smaller middle market companies perhaps, or privately held companies, a significant shareholder or owner might decide to retire, and this way this will pave the way for existing management team to potentially own the business through a leveraged buyout. And let's now take a look at the ideal LBO candidate. First of all, as we mentioned already, you must have an experienced management team. A strong CEO and CFO are absolutely critical. Why? Because the CEO is supposedly supposed to provide the strategy and the strategic direction, whereas the CFO is the numbers person. And therefore, they are the ones who are probably among the most critical, as well as, of course, making sure that the company is intact. So COO, sales, etc., marketing, all obviously very critical as well. Financial profile, this is pretty important. The company must have an ability to generate a steady stream of cash flows. If the cash flows are not there, nobody's going to buy the company. Why not? The private equity firms need to make sure that there's steady cash flow to pay off the debt so that their equity stake does not go to nil. The banks, the ones providing the leverage and the debt, they want to make sure that they can get repaid, so there must, once again, be a steady stream of cash flows. This is probably one of the most important attributes of an ideal LBO candidate. Why? Because these cash flows must fund the operations and continue to pay down the debt. In conjunction with that, there must be low debt balances, or there ideally would be a low debt balance. Why? Because therefore, additional leverage can be employed on this LBO. If you're already fully tapped out, and you can't do much additional with your capital structure, that's going to be a potential problem here, because if you already can't borrow additional funds to fund this leverage buyout by definition, you might have a little bit of a problem there. High cash balances are ideal as well. Why is high cash balance? Because that, first of all, offsets the debt, but also you can use the cash clearly to actually pay for the actual leverage buyout acquisition. In combination with all of these, you must also have a relatively cheap valuation. Why must you have a relatively cheap valuation? This way, if the public markets are undervaluing this particular entity and this firm, you can now go in there and you don't have to pay as much than if it were already fairly or overvalued. And therefore, from the perspective of the financial profile, it is very important to make sure you have all four of these components as much as you can. Also, there must be sufficient assets for collateral. Why? Because if it can be backed by assets, what you can do is the banks are going to be able to come in and be more comfortable loaning you the money. Because at the end of the day, banks being slightly more conservative than, let's say, the private equity folks, not necessarily the case, but generally speaking, they want their assets back as soon as possible. And if the company is not able to generate the cash flows, they want to know that their collateral is going to be worth something. And of course, you have industry factors that also influence operating risk. Do you have a competitive advantage over your competitors? Do you have a stable growth of demand? Is there high barriers to entry? What are the trends in regulation impact on operations? All of these are key items to determine whether or not you have a good company here that's a good potential LBO candidate. Now, let's look at the true drivers of value. From where is the money actually coming from in a leveraged buyout? First of all, we already know that this is basically a massive stock buyback. You're basically increasing the amount of risk that you have, because why? You're employing a massive amount of debt, to buy back the equity, effectively wiping out the entire current equity base and putting a significantly smaller percentage of equity on a relative basis. At this point here, you can also pause this video and refer to our exhibit on share repurchases, in which we describe in a regular share buyback, in a regular stock buyback program, you should have an increase in the stock price. Why you shouldn't have an increase if the financial markets and the capital markets are efficient, and again, in what circumstances are they going to be efficient. So please refer to that exhibit. Now might be not a bad time to do that. But generally speaking, at a massive stock buyback, you might see an increase in stock price for three qualitative factors. First of all, you basically reduce your shares outstanding. That increases earnings per share. Assuming constant PE ratio, stock price should go up. Behavioral effect. The management thinks the stock is undervalued, therefore they will buy low, sell high. And of course, basic economics, reduce supply, increase demand. However, if that's the case, again, we also prove in our share repurchase exhibit that there should be no additional value extracted. However, how is that going to be different from a leveraged buyout? First of all, you lower the cost of capital because you swap your equity for your debt. Now, this is potentially counterintuitive. Why? Because the required return on the private equity capital is high. We said 25 to 30%. Whereas what you're doing is also leveraging the cheap source of capital to minimize your down payment. This is key, folks. What this means is your debt is going to be a smaller percentage in terms of the cost of the debt, the cost of capital. However, ultimately what you're doing here is, and this is the key, you are using other sources of capital to minimize. You're using other sources of capital to minimize the amount that you have to pay for this company. So if I said to you, I give you the opportunity to buy a huge mega billion-dollar company, but you pay $1, and in 5 to 10 years, the internally generated cash flows pays off the debt, and now the whole company is yours. Who's going to say no to that? No one's going to say no to that. Therefore, from that angle, what you look at it is to say the reason why the leverage buyout works is because you're buying an entire entity and not paying that much of your own capital, and you're going to use the cash flows generated to pay down the debt over time, such as your equity increases. This is different from a traditional, smaller share repurchase. Why is this different? This is different because in a traditional, smaller share repurchase, the equity base is still outstanding. You're not wiping away the entire capital structure. And again, we talk a lot more about that in our share repurchase exhibit. Again, using internal cash flows that are generated to pay off your debt to build equity. That is critical here. And of course, on a side tangent, this removes the company from public scrutiny, and therefore you don't have to worry about short-term results. As we all know, sometimes there's too much of emphasis on quarterly figures. And therefore, you can kind of operate your own company at your own pace without additional oversight that's necessary. Now, moving ahead, let's take a look at the different components if we were to build an LBO model. And of course, you will follow this up with our quick and dirty basic leverage buyout modeling as well as our complex modeling. Here is our LBO summary exhibit. In this LBO summary exhibit, let's go over the main components. We will look at each one of these boxes independently and in greater detail. First of all, you start with the illustrative transaction assumptions. You just kind of say, what kind of accounting are you using? We'll talk more about purchase versus recap accounting. What's the date of acquisition? What's LIBOR, etc. Then you look at the critical valuation summary. In the valuation summary, you have to figure out what am I currently being valued at and what am I going to buy the company at. In this case, we're assuming a 20% premium. Additional debt capacity is very important. Additional debt capacity basically says what is the maximum amount of money you can borrow additionally to fund this leverage buyout. Then you have your sources and uses of funds. Your sources and uses of funds are absolutely critical. If you had to ask me which one of these boxes or which component of a leverage buyout would I want to analyze if I could only choose one, clearly without a doubt it would be the sources and uses of funds. Why is the sources and uses of funds so important? It's very simple. Where are you getting your money from and what are you using to pay? Where are you getting your money from and what are you going to use that money to pay off? I need to know that because I need to figure out this goes into deal structure, this goes into valuation, this goes into a whole host of issues, and everything in your leverage buyout model ultimately is dictated by your sources and uses of funds. Then we have our equity sources, where we'll talk a little bit later on about rollover equity, as well as goodwill calculation, as well as summary returns and credit ratios once you are done building the rest of your model. You would always want to build a sensitivity analysis. So here's the switches page that basically says, well, let me take this and let me start sensitizing and controlling how I want this model to work. In our complex leverage buyout modeling, what's pretty cool about that module is one of the most complex leverage buyout models out there. We give you the ability to toggle between status quo and a full-blown LBO. In our enhancements, leverage buyout enhancements course, we also build in stuff like picks, recaps, less than 100% purchases, etc., and we'll build all of that into our model as well. We also will want to sensitize the interest rate scenarios, as well as our refinancing scenarios, a brand new capital structure post-transaction, as well as, of course, our option information to really build as detailed of a valuation as we can. We'll go into each one of these segments starting now. Now what we're saying is that leverage buyouts are extremely sensitive to the cash flows produced by the core asset. We've already talked about that. As such, building a detailed and comprehensive LBO financial model is absolutely critical to capturing and sensitizing all the various inputs. Major sections required to build an LBO, as we just talked about, are listed here. Why don't we take the time now to go through each one of these different boxes. Let's start with the valuation summary. The valuation summary, in a nutshell, models out the current valuation parameters as well as the transaction value. So you always want to look at status quo. How much is this company worth? That's the current. And then, of course, post-transaction, how much are you paying? How much are you paying? Okay, and that is the importance here. You want to properly estimate the acquisition price of the target company, and of course the implications should be straightforward. Too high of an acquisition price results in low returns. Too high of a price results in low returns, which is why the more undervalued you are in the public markets, the better and potential LBO candidate. Why is that? Simply because if you pay too much, you're not going to get your returns. You have to put in too much equity and you have to fund too much debt. So the lower you have to pay and the less you have to pay, the better off you're going to be there. Additional notes, you want to make sure that you properly account for options exercisable versus outstanding in equity value calculations. This is very important because that will have severe implications on the value of the firm as well as the cash flows that you have to pay out. And therefore, you want to make sure that this is done as clearly as possible. And take a look at our other basic modules as well as our advanced financial modeling for, again, a fuller explanation of options exercisable versus outstanding, and also our treasury method exhibit, treasury method of adjusting for shares diluted shares outstanding. Take a look at exhibit there for the actual math. In general, we want to include all forms of capital in your enterprise valuation: equity, debt, preferred, minority interest, etc. However, minority interest, which we talk a lot more in our corporate valuation course, you want to make sure that that is not actually paid for in your sources and uses. Now, let's quickly go on to the next slide, and then we'll talk more about the minority interest on that footnote there. Additional debt capacity basically says, if you recall, the whole purpose of this LBO is to do what? Try to fund as much as you can through debt, so you put down as little of your own equity as possible. Therefore, you want to try to figure out what is your additional debt capacity, the maximum debt that you can employ for this particular transaction. That, of course, is going to be absolutely critical because you, again, want to minimize the amount of equity that you put in. Therefore, you want to calculate your total debt capacity to estimate and maximize additional new debt borrowings. Why is this important? The higher the debt relative to equity, the higher the potential returns to the equity investors. However, there's definitely going to be an inflection point where the internal cash flows cannot pay out the interest. Therefore, you're not going to be reducing your debt principal very much, and you want to make sure that's why you're building a full complex model to see where is the point, where is the ideal deal structure that I will maximize my IRRs, my internal rate of return. Typically speaking, your debt capacity is determined by debt to EBITDA ratio, and these ratios, or another comparable ratio, is dependent on the current credit environment and is industry and sector specific. That's key, folks. Remember, as we said, this is a snapshot of the current market views of what you can do in the LBO market. Therefore, this is very dependent on the current credit environment. Is it tight credit? Is it loose credit? Etc. And it's very industry and sector specific, as there will be different parameters of gauging the level of debt depending on the industry that you are looking at. As we mentioned already, minority interest, as we talked about again in our previous courses, minority interest is excluded from debt capacity because you do not actually pay for the minority interest. And therefore, from that perspective, when we have said before, on our total enterprise value minus net debt equals equity value, and we had stated that our net debt includes minority interest. In this case here, we will not include it because it is not an actual form of capital that you have to physically pay for. It's an implied number. Please refer to our corporate valuation module for more information on that. Implications on this. The additional new debt capacity is dependent on whether or not existing debt is refinanced. If you refinance your existing debt, this means that your additional debt capacity is higher. You can borrow more because you paid off your old debt. But of course, you need additional money to borrow and refinance that debt. So therefore, there's going to be an offsetting factor there. Let's take a look at the next slide now, refinancing scenarios. All we're saying here is that you must build in a variety of refinancing scenarios to properly automate and sensitize your financial model. And the importance of this is you want to project this as much as you can to properly, again, sensitize. You have to understand the drivers of value and whatnot. So here we have, in this simple case here, 3 different refinancing scenarios. Here's our no transaction. That's our status quo. And here we have a very simple, we say no refinance. This means that all current debt stays. And then we say refinance everything, blow it all out. And of course, you have to pay additional financing fees as well as potential tender costs if you decide to refinance your debt. We'll talk more about that when we get to the expenses page. You could build in a super sensitivity analysis, right? To expand the functionality to a recapitalization, which is a massive share repurchase, right? A less than 100%, we actually do that in our complex LBO enhancement section. And of course, you can also choose to refinance selected tranches of a target's existing debt. Why is this important? Because refinancing scenarios will significantly alter the profitability and returns of an LBO. Let's talk more about tender costs and expenses right now. Tender costs. These are basically some of your more important expenses, definitions, and your accounting treatment. What are tender costs? Tender costs are what we would call the cost of tendering. Okay, that's very value added there, but basically it's a good guide premium for early repayment extinguishment of debt. Folks, what this means is that normally corporate bonds, etc., will not have a prepayment penalty for the vast majority of times. However, you have to instantaneously go back into the markets if you decide to refinance this existing debt. You have to instantaneously go back into the market and then borrow more money. So these institutional investors might be a little bit upset that now you're suddenly saying, well, hey, listen, sorry, folks, I'm taking out, I'm buying out, and you're going to lose that additional income now. And if interest rates have moved, then basically they may not get as much as what they had expected to get. Also, many times you will be required to refinance your debt upon certain types of control changes, which is all dictated in the covenants to each specific debt agreement. If you have to do that, then you have to pay what we call tender costs. And these tender costs are the costs of buying back the debt. Many times, again, you may not have to pay an explicit prepayment penalty. But to keep the institutional investors happy on the debt side, because you have to go back and tap into their capital right away when you do the LBO, you basically want to say, okay, I will pay you out for the interest, the present value of the interest that you would have received if this were held to maturity. But because we're forcing a repayment on this, we're basically going to go ahead and we're going to give you a good guide premium so that we keep you happy. Money talks. So therefore, many times also, you will end up renegotiating on a select one-to-one basis on how to renegotiate that refinance debt. That's fine as well. But to
All right. And hopefully with you guys chiming in and getting in, this is compliance officer training. This is trustee training. All of the above, we're going to be continuing. We can consider this part 6 of dealing with funding through the DTC and DTCC part 6. We're talking about LBO modeling. And now, for those of you that have been progressing through the loan disc automated software, those of you that have implemented your securitization audit, those of you that have secured the last part of your securitization audit, meaning that you should have received an email, some of you guys received invoices for additional filings, you are all caught up. Then what you're now listening to is the leverage buyout modeling that could be presented during the securitization audit. Now, I am not going to go all the way back to the beginning and explain leverage buyout and leverage cash out. What I'm going to say is listen, take notes, and prepare to ask questions. If you ask questions, that will allow me to answer those questions from a certain perspective. And for those of you that are in a bank in the box, hint, hint, wink, wink, the more questions you ask, the stronger the algorithm becomes. So it is essential that you express certain questions in a certain aspect of understanding and tangibility to get the result necessary. Why? None of us are mind readers. I've given everyone adequate accounting documentation. I've given you DTC and DTCC implementation guides. You now actually have direct access to the arbitration registration investment system, which is tethered to the DTC and DTCC, as well as any other Euroclear platform. So the question is, if you're still sitting around trying to figure out where funding is coming from, you don't know what form to fill out. Shame on you. You need to do some more studying, especially now that we implemented the Banking in the Box GPT or Chat GPT version. Yes, we have deduced Banking in the Box to an algorithm that runs directly on top of Chat GPT. And again, I cannot make this any easier than it already is. Loan Disc is a arbitration tool that monetizes what you're conveying. but how you're conveying is the essential of how you're prompting. When you start saying, well, I want to do this, that, and the other, and you get into that collateral line, you get into that subject matter, that subject jurisdiction line, that is the equivalent of making a prompt into the algorithm. So if you've been studying, you know exactly what to put in there. If you ain't been studying, you're looking for some sort of template. You're looking for someone to tell you what you should already know when it comes to this, that, and the third. Now, when we go through the audit, we're going to go down line by line, precept to precept of what it is you're doing, because we can only convey to a competent fiduciary. So all these things run in tandem. And the fundamentals are insurance and reinsurance. Now, if you haven't figured it out yet, we've affiliated and attached ARIS's very own ChatGPT tool. So if you're unsure on what to ask, you have an ability to convey it, conform it into a proper format before you even interdate the system. So leverage buyouts are the result of a leverage cash out that is used simultaneously. And what Han is talking about is the modeling perspective of this. But let's now give a quick refresher for those of you that are new and give you an opportunity to ask your questions based upon what we're talking about in context. I will give everyone adequate time to ask questions directly, meaning that if you press 9-4 on your keypad, that will prompt me that your hand is raised. I will then give you an opportunity to ask a direct question. If you just can't wait and you got a question that's on the top of your head, then please post that question inside the chat. I will go through those questions in the chat, and those of you that have your hand raised accordingly. If I get no response or no questions, I'm assuming that you are on your way to the next level of implementation. But let's kind of just back up just for the new people. And again, when I say new people, those of you that have just joined us in this space over the last 2 weeks, last month, you're considered new around here. What I'm going to do for the new people is I'm going to technically go back in time to some information that I think should be helpful to kind of catch you up to speed. Like we always say, keep listening, because if you listen long enough, you definitely will learn something.
Understanding asymmetric information. Recognizing the asymmetric nature of AI and its impact on decision-making is essential for developers and financial professionals. AI's role in influencing and guiding decisions cannot be underestimated. Conclusion. In conclusion, AI-powered financial systems offer unprecedented opportunities for efficiency, accuracy, and optimization. By embracing the power of AI and advanced language models, financial professionals can make data-driven decisions, stay ahead in an ever-evolving industry, and revolutionize the future of finance. The integration of AI is not just a trend, it's a transformative force shaping the financial landscape for years to come. Revolutionizing financial processes, the power of accounting reconciliation and funding. Introduction. In the ever-evolving landscape of finance, the potential to revolutionize financial processes is at our fingertips. This article explores the power of accounting reconciliation and funding, shedding light on how these aspects can transform the financial sector. Ledger Accounting, ABC Trust Estate Accounting. ABC Trust, an innovative approach to estate accounting, utilizes a unique accrual method that diverges from traditional T accounts. Instead, it employs a combination of plus and minus signs in its ledger, along with notarized and witnessed accounting transactions. This unique approach ensures the accuracy and legality of its financial records, providing an indisputable record of all financial activities. Leveraging AI in reconciliation and transactions. Artificial intelligence, AI, is poised to play a pivotal role in reconciling complex financial transactions, guaranteeing accuracy and integrity throughout the process. By harnessing AI, financial institutions can streamline their reconciliation procedures, making them more efficient and dependable. Transaction funding with AI. AI doesn't stop at reconciliation, it can also be utilized to analyze and substantiate transactions, ensuring seamless and efficient funding regardless of the medium of exchange. The integration of AI in transaction funding promises a more robust and reliable financial ecosystem. Automated underwriting software. Major corporations and financial institutions heavily rely on automated underwriting software. This technology is instrumental in qualifying, sequencing, and conveying transaction values efficiently. Understanding the role of automated underwriting software is crucial for those navigating the financial sector. Addressing taxation and liabilities. Navigating tax credits and liabilities is paramount when issuing transactions. Proper accounting and reconciliation processes are essential to ensure compliance with tax regulations. This section delves into the critical aspects of handling tax implications in financial transactions. Private versus public side. Distinguishing between private and public accounting and providing clear notice to all parties involved in a transaction can mitigate potential issues. Understanding the nuances between these two sides of finance is essential for financial professionals. The role of APIs and financial institutions. API integration serves as the bridge between data sets and financial institutions, facilitating seamless interaction and access to essential information. As the financial sector evolves, APIs play an increasingly critical role in ensuring smooth transactions and data sharing. Monetizing data sets. Financial institutions are now exploring opportunities to monetize their data sets by offering access to APIs for a fee. This development has the potential to revolutionize the industry, opening up new avenues for data-driven financial services. AI as a future game changer. Recognizing the asymmetric nature of AI and its impact on decision-making is essential for developers and financial professionals. AI-driven decision-making is becoming increasingly prevalent in the financial sector, offering unparalleled opportunities for informed choices. Conclusion. In conclusion, the power of accounting reconciliation, AI integration, and efficient transaction funding are shaping the future of finance. Understanding these components empowers financial professionals to navigate the financial landscape with precision and adapt to the ever-evolving industry. Embracing the potential of AI and technology will undoubtedly be a game changer for the future of finance. Understanding the role of lays and glaze in finance. Introduction. In the realm of finance, there are vital components that many are unaware of, especially concerning LEIs, legal entity identifiers, and GLEIs, global legal entity identifiers. This article will delve into their significance and how compliance officers can utilize them effectively. The power of legal entity identifiers. LEIs are essential identification numbers associated with entities involved in financial transactions. Here, we will explore how these identifiers can be a game changer for both compliance officers and financial entities. Leveraging LEIs for funding. Discover how LEIs can be instrumental in securing funding for entities, even in complex financial scenarios. We'll discuss the integration of LEIs with arbitration and automated underwriting software, which can make entities more bankable and marketable. The role of automated underwriting software. Learn about the significance of automated underwriting software in the financial sector. Find out how it can streamline the qualification and sequencing of transactions, making the process more efficient and reliable. Addressing the specifics of documentation. When utilizing LEIs and GLEIs, proper documentation and clear communication are crucial. We'll explore how compliance officers and entities can effectively communicate their needs and desires, ensuring the right forms are generated for each transaction. Securitization audit and accounting. While LEIs provide valuable data, understanding how to use this information in a securitization audit is equally vital. Here, we touch upon the principles and methods used in securitization audits and how they relate to LEIs. Closing thoughts. In conclusion, the world of finance is full of hidden gems like LEIs and GLEIs. These identifiers can revolutionize the way transactions are handled, making entities more bankable and efficient. As compliance officers, understanding how to leverage these tools effectively can lead to success in navigating the complex world of finance.
All right, you guys should be able to see my screen if you're actually locked into the actual link where we're doing the class, where you can see my screen. And on the top of the screen, you should see a title that says Statement of Account, DTCC. Now, for new people, I am going to talk about two distinctive bills of exchanges. One is being used for the DTCC, and then another that's used for the DTC. Now, for you to know which is which, I want you to put DTCC. This is the side of the court registry investment system where withdrawals are coming out of the court registry investment system. This is the side of the court registry investment system where withdrawals are coming out of the security settlement system. So this title of Statement of Account is to solidify what type of documentation that you're going to need for the reinsurance. So the statement of account is affiliated and associated with the reinsurance of what was placed on deposit on the DTC side, which was done through the insurance. So the statement of account is directly affiliated with the reinsurance. Now, what you're looking at is this bill of exchanges. It's actually called a documentary draft. Now, again, this is just for reference purposes. We use something very similar like this in real time, but I'm using this to kind of give you a visual of what we're talking about in this capacity. So this particular bill of exchange is used by fiduciaries who are withdrawing funds from the court registry investment system. Now, right here in the special instructions, and this is not just all, pertinent that you get your verbiage just right in this capacity, because when we do the securitization audit, we're going to be very specific based upon what needs to be done. But as you can tell in the special instructions, it says something like this action is a requirement placed upon the district court of the United States, blah, 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 United States government, private American estate banker to honor and support the American people in the American state when called upon under Title 28, United States Constitution, United States Code section 1346, subsection 2A. And again, if you don't know what these sections are, when you go back through this particular video, and those of you that have access to ChatGPT, you should not be going through any part of this class without knowing exactly what we're referring to and in what reference. So I suggest you do some research as to what Title 28 United States Code section 1346, section 2, subsection A pertains to. But if this action is denied, it will then be presented to Superior Court of the United States of America, the United States Court of International Trade, per enacted statutes at large addressing this international banking court in order to obtain true justice per the American treaties. Then you have a representative that's going to be listed on a 56 form as the fiduciary. You're also going to have an executor that's going to be listed on the form 56. You see that there. This is also still referred to as a statement of account. It's giving you now the place of drawer intel. It gives you the estate, EIN. And again, those of you that are going to get yourself into a tizzy about, oh my God, what do I put here? What do I put there? This is why you have the AI tools. This is why, if you haven't already ordered your manuals and data sets, because these things are available as well, you're going to need them so you know how to fill these things out properly. Why? Because there's way too many individuals in the supposed guru space that is doing X, Y, and Z. I am coming from current expected credit loss provisions. I'm utilizing the disaggregation provision, which is directly tethered to current expected credit loss provisions. And if you don't understand CECL and DISE, then you need to understand why we are saying what we're saying and implementing these things in this particular format, especially if you have no clue on what Regulation J and Regulation Z is when it pertains to the federal regulations dealing with Article 9 conveyances. Well, Article 3 conveyances, excuse me. Article 9 is actually the interest that you have in such conveyance. This is why and then also is endorsed under Article 3. There's the signature of the judge, signature and seal. You actually have now what we consider the certified proof of funds. It's going to be attached to a GLEI. And also, there's also going to be a court-registered investment system debit account that's also available. And again, I'm showing you this because the first bill of exchange, this one here, is how things come out of the CRIS. This bill of exchange here is what puts stuff into the CRIS. That's why it's referred to as a DTC, bill of exchange. And I'm just giving you an example of what it looks like because this bill of exchange is affiliated with a judgment fund transmittal document that's done off of the Bureau of Physical Services. And it is governed under a very specific statute. Mr. Bay, what is the statute? What is the statute that you're talking about? Well, let's see. Title 31 United States Code 1304 is one of them. And let me just kill this right here so you kind of see it from a different perspective here. Okay. Title 31 United States Code 1304 subsection A3A is why you're able to utilize the court registered investment system in this capacity. Now, again, I'm not giving legal advice. I got new notaries who have just been trained. Some of you guys are basically trying to figure out what it applies. I'm highlighting something that may be of interest to you guys. Can you see what I just highlighted? I'm going to see who's paying attention now. I'm going to see who's paying attention. Yeah, because you give me that nod like maybe you're going too fast. Let's slow down. Press 9-4 on your keypad if you're lost. Press 9-4 on your keypad if you got any questions over what I'm showing you. Press 9-4 on your keypad if you trying to figure out what statute am I under that gives me the ability to put things inside the court registered investment system and take things out. Press 9-4 on your keypad now, because I just highlighted what it could pertain to. I didn't highlight this one, but I'm going to highlight this as well. One of these is public, one of these is private. So it depends upon who you are, what's applicable. If you need clarity, I suggest you press 9-4 on your keypad now. Everybody gonna say they understand, right? They got this. They ain't lost. They understand what that whole provision is. They know where they're going. Okay, that's what I thought. All right, I'm gonna call the last 4 digits of your number, which is going to be 4917. 4917. Thank you for your honesty.
Hey, how you doing?
All right.
I'm not looking at the screen, so I can't see exactly what you're doing. But I'm understanding that you can only do it from a private capacity.
Okay, so you can do it from a public or private capacity because there's rules that govern the entity or fiduciary that's in question. I'll give you an example.
Public, you'd have to be from a notarial standpoint?
I am going to say the safest place, all right, when you're saying, are you talking about from you implementing this, or you're trying to assist the client with implementation? Okay, if you're implementing this, let's back that question up. Who are you in the transaction? Are you coming from the public side of the fence or the private side of the fence?
Well, right now, the public.
Okay, and so let's be specific. what the specifics of what you're doing is going to determine which avenue you take. So tell me, and just off the top of your head, because I know you knew, what you would like to use this for, and I'll let you know which one you probably gonna be tethered to. Now before you go down the rabbit hole, I'm gonna ask questions in a way to kind of get you to answer your own question. So from the perspective of what you're thinking, tell me how you would want to use this provision.
Okay, and provision, you're saying putting things into the DTC.
Okay. All right. So when we say putting, let me clear this because I don't want to get you in trouble. All right. Whether you do anything that I'm telling you or not, this is still happening. So if you go out and get a ticket and give them fiat, that ticket still went into the court registered investment system on the DTC side, and it was reconveyed on the DTCC side. My question is, did you benefit from it?
No.
If you didn't, then if you want to benefit, then you're gonna know which way to engage what we're talking about. But just general, because a lot of folks will ask questions from a general perspective. The public is dependent upon government. And when you start saying you're going to do stuff from the private, you're trying to lessen the burden of government. Now, here's a catch-22. You can't say you're going to be a secured party creditor and this, that, and the other, and you're going to use your secret private account and all this other hoopla, and then go get your fiat check and cash it at Bank of America. You can't do both. Because your concept of accounting causes you to commingle. It's just like to know which way to go and how to interact. In your present method of accounting, is getting a tax refund a good thing for you, or is it a bad thing for you?
Well, I would say in my current, I would perceive it as being good because it's money coming back. From what I'm quickly learning is it's not.
Right. So if you want to get in line with the provision, because the provisions are unmutable, you can't change the provision. You just have to change your position. So
right.
If you want the explanation of how to do this publicly, there's a whole 5-minute, 10-minute presentation I can go through to tell you how to do it publicly. If you're trying to stay private, then I want you to listen to what you're saying, because it's associating the right type of asymmetric information to move privately. Individuals will say they're private, but their actions will dictate otherwise. So it's never what you say, it's what you do that determines who you are. Because if you haven't noticed, there's a lot of folks in the public that are operating privately. Did you catch that? There are a lot of individuals publicly that are operating privately. So they're going to say certain things. And then you'll understand, here's the test. When government makes accusations of, oh, you did this illegally, or you did this legally, all they're really saying is you did this and it's taxable or non-taxable. But if you're not learned, you're going to act a certain type way. It's never what you say, it's what you do that determines who you are. So you got to remember, all of this is tethered to your actions. So if you were using this from a public perspective, there's going to be certain tax forms that's going to allow you to move. You can't see my screen, so I'm going to go to the screen, which is going to determine FTCA withholdings. FTCA withholdings. Again, for the recording, FTCA withholdings. Based upon how I'm explaining that, you got any idea what FTCA withholdings stand for?
No, I don't.
Okay. Now I'm going to kind of share the wealth a little bit. Is there any of the other students that want to help out our new student here with what FTCA withholdings stand for in the aspect of public conveyance, public accounting in that regard? This is an open book question. So if you say, Mr. Bay, I don't know. If you got ChatGPT, put it in ChatGPT and you tell me. I need you to participate, because if you do, you'll learn something. If you just listen to me rattle off, it ain't helping you, because you're not understanding why I'm saying what I'm saying. I need you interacting with this. FTCA withholdings. And I give everybody a chance to put their questions inside the chat. Let's see here. Should have some folks that put it inside. Okay. Got somebody that says federal tort claim. Beautiful, beautiful.
Foreign tax credit.
Foreign tax credit. I got Foreign Account Tax Act. Beautiful. Now, let's talk about this from the right perspective. Let's go back. So I'm going to say FTCA. Hold on. Yeah, Brazil. Just do it so everybody can see it, because we want to make sure everybody gets this. Because I don't want nobody lost. I don't want nobody going on saying, "Well, I didn't know. He didn't tell me." No, I'm going to show you. Let's go here. Let's go here. All right. Because I don't want you guessing. I want you to know. Now, all right, we're going to prompt this particular chat bot to tell us what is...
You may want to mute me.
Okay.
I got noise in the background.
Gotcha. All right, will do. If you want, you can mute yourself. If you can, I will definitely do it.
How do you do that?
Just if on your device, you can just press mute on your speaker, and then I will.
Oh, gotcha.
Right. All right, those you can see my screen. All right, as you can see, we're getting the result. Here's the breakdown. Now, FTCA stands for Federal Tort Claims Act, which is dealing with withholdings, referring to the withholding of funds from a federal agency's budget or appropriations to cover potential liabilities arising from tort claims against the United States. Key word, against the United States. The FTCA allows private individuals to sue the United States government. Yeah. Y'all seen that. That's why this is why, this ain't me. We're just having class here. Where did that? All right, here we go. The FTCA is a federal statute that allows private individuals to bring lawsuits against the United States for damages due to personal injury, death, or property damage caused by negligence or wrongful acts or omission of a federal employee acting within the scope of their employment. Before the enactment of the FTCA, the United States government enjoys sovereign immunity, which means it could not be sued without its consent. So please understand that this is the part of the legislation that holds these administrators' feet to the fire. Let's back up. So if someone in the public is not allowed to use lawful legal money, would it fall up under FTCA? If the general population, if the public is not allowed to use lawful legal money, would that be a violation of FTCA? Would that fall within the scope of the Federal Tort Claims Act? And I'm giving everybody a chance to definitely put their answers inside the chat. I'll ask the question again. If the general population, if the United States citizen deems that he can only use lawful legal money, and for some reason these bonded officials do not allow such a thing, isn't that a violation of FTCA? Hello, is the mic on? Everybody can hear me? Okay, beautiful. Okay, I'm make sure y'all there now. There you go. There you go. All right. Now, definitely it would equivalent that you are in violation of that. So this is key. Now, under the Federal Tort Claims Act, and then also under debt set-off pursuant to Title 31. Now, again, let's get this down so nobody's lost as to which one applies to what. We're going to go to ChatGPT once again. What is right? Put question mark there. Let's see if I did this right. I should get a response. And the beat goes on. It goes on. It goes on. It goes on and on and on and on. As you can see. Interesting. Now, as it populates, I'm going to give it a minute to finish populating before I go into it. States here that the term set-off, debt set-off, refers to the process by which the federal government can offset or reduce certain payments to individuals or entities in order to collect a debt owed to the United States. Pursuant to Title 31 United States Code, subsection 3728, the federal government has the authority to withhold part or all certain payments to satisfy a judgment against a debtor. Here's a breakdown of Title 31 United States Code subsection 3728. The authority. This section of the United States Code gives the federal government the authority to withhold money from payment due to a person or entity if that person or entity owes money to the United States as a result of a court judgment. Let me ask you something. According to the debt clock, every United States citizen, every taxpayer owes minimally $337,000 in taxes to the government. So, anytime you use lawful legal money, this is an opportunity for the United States to collect what's owed to them. Next, payments subject to set-off. The types of payments that can be offset under this provision include payments due to the provisions of goods and services, tax refunds, retirement benefits, other federal payments. However, there are certain exceptions, and not all federal payments can be offset. Limitations. The amount that can be offset is limited to the amount of the judgment debt plus any interest and costs. Additionally, the government must provide the debtor with notice of an appointment or opportunity to dispute the debt. If fiduciaries are in some type of dispute, isn't that grounds for arbitration? So let's replace to dispute to arbitrate the debt before the set-off occurs. Get it? Got it? Good. Conditions, coordination with other laws. The authority under Title 31 United States Code subsection 3728 is in addition to other laws that allow the federal government to collect debts owed to it. This means that the government can use multiple methods to collect a debt, including administrative offset, wage garnishment, and tax refund offset. This is why when we tell certain fiduciaries to do an 8302 tax return, allow that to take care of all public scrutiny. See, once you put a refund inside the system that they can offset and apply to their debt, now you're free to move with lawful legal money. And this is a different way of thinking for a lot of individuals in the public. Now, again, not giving legal advice. I'm simply just pointing out the obvious because this is our come from when you get inside of loan disc and you're going to be going through these securitization audits. Now, I think at this point, maybe, just maybe, I might have did a great job and everybody gets that, but I may have a few people that may still be a little lost. So at this particular time, if you're one of the many or a few that are a little bit foggy, please press 9-4 on your keypad so that I may ask some questions and see if I can get you into the right frame of mind in terms of what you need to be doing when it comes to certain transactions. Again, press 9-4 on your keypad if you got any questions, comments, or concerns of anything we covered up until this point. Okay. I don't see anybody pressing 9-4 on their keypad. Okay. So since we don't have anyone pressing 9-4 on their keypad, keep listening, because if you listen long enough, you will definitely learn something. And again, it will be to your advantage that if you have questions pertaining to Article 9 security interest, M3 conveyances, what exactly does the securitization audit provide, this will be the time to ask those questions. Let's see here. I'm going to let's back out of here because I want to do something right here. Let's see. Can I? Oh, it's not letting me back out of here. All right. So let's see. All right. I don't know if my audio dropped off, but I'll just pick it back up from the top. Quote unquote, I'm giving everybody a definite chance and opportunity to ask questions pertaining to any type of Article 9 security interest, anything pertaining to the automated underwriting software, and also understanding the importance of utilizing lawful legal money when it comes to dealing with funding through the DTC and DTCC. Please, if you got any questions pertaining to any of those things, press 9-4 on your keypad so that I may bring you on so those questions can be answered. And I'll give everybody adequate time to do so. I know my audio dropped off. Back on now. Should be coming in loud and clear. If you got any questions, please press 9-4 on your keypad so that I may bring you in so we can address those questions. Again, if you got any questions, press 9-4 on your keypad so we can address those things. And again, if you don't want to press 9-4 on your keypad, but you do have a question, feel free to post inside the chat, and I'll do my best to answer that question. And I'm going to give you a little bit of time to do so, because time is of the essence. And remember, I'm only as good as you guys allow me to be. So if I don't get any questions, I'm simply assuming that you are getting this. And so, I'm going to be moving pretty quickly through the remainder of this particular information. But again, if I got some new folks that are a little bit unsure about what they're listening to, then this is your chance. So again, please press 9-4 on the keypad if you got any questions, comments, or concerns or anything that we talked about up until this point. Going once, going twice. Since I ain't got no questions, keep listening, because if you listen long enough, you definitely will learn something.
Welcome to another episode of The Digital Evolution of Finance. Today, we're diving deep into the future of financial conveyances, exploring innovations that promise to reshape the financial landscape. From the revolutionary ARIS platform to the cutting-edge banking in the box and the comprehensive M3 asset data sets, there's a lot to unpack. So, let's get started. In the modern financial world, the demand for efficient, transparent, and secure systems is higher than ever. And platforms like ARIS have been game changers. But what exactly is ARIS? ARIS, or the Arbitration Registry Investment System, is a centralized registry for arbitration cases. Think of it as a bridge connecting claimants, who might be struggling with legal fees, with potential investors ready to fund their cases. A real-world example that comes to mind is the small business owner, Jane from Jane's Organic Juices, who faced a legal battle against a beverage giant. With ARIS, she found investors who believed in her cause, enabling her to pursue justice. But ARIS isn't working alone. It's in collaboration with major entities like AAA, CRIS DTC, DTCC, and Euroclear, ensuring the arbitration process is as smooth as silk. Now, let's talk about a product that's been making waves in the banking sector, Banking in the Box, powered by ChatGPT. Imagine having a personalized banking experience, integrated with systems like ARIS, and providing real-time updates on M3 assets. It's like having a personal banker in your pocket. And speaking of M3 assets, the M3 asset data sets are truly revolutionary. They represent a comprehensive repository tailored for the conveyance of these assets. With these data sets, asset conveyances are as simple as clicking a button. It reminds me of how online platforms like Airbnb or Uber revolutionized their respective industries with user-friendly interfaces and real-time updates. Let's delve a bit deeper into the advantages of these M3 asset data sets. First, efficiency. Gone are the days of endless paperwork and waiting periods. These data sets have streamlined the process, making it quicker and more efficient. Second, transparency. Every transaction, every detail is available at your fingertips, ensuring complete transparency. Third, security. With state-of-the-art encryption and authentication protocols, your assets and data are in safe hands. To wrap things up, the integration of ARIS, Banking in the Box, and M3 asset data sets is setting the stage for a more accessible and user-friendly financial future. As we continue to embrace the digital age, these innovations are leading the charge, promising a brighter, more efficient future for all of us in the world of finance. Thank you for joining us on today's episode of The Digital Evolution of Finance. Stay tuned for more insights into the world of finance, and as always, keep innovating. The Digital Transformation of Financial Conveyances, a Comprehensive Guide. Introduction. In the modern era, the financial landscape is undergoing rapid transformation. With the advent of platforms like ARIS and innovative solutions like Banking in the Box, the way we manage, convey, and report financial assets is evolving. This article offers a deep dive into these groundbreaking innovations, their implications, and the future they promise. First, ARIS, pioneering arbitration case management. ARIS, a centralized registry for arbitration cases, has revolutionized the way we connect claimants with potential investors. By collaborating with entities like AAA, CRIS, DTC, DTCC, and Euroclear, ARIS ensures a streamlined and efficient arbitration process, benefiting both claimants and investors. First, banking in the box, the future of personalized banking. Powered by the ChatGPT version, Banking in the Box provides a personalized banking experience that integrates seamlessly with platforms like ARIS. This next-gen banking solution offers real-time updates on M3 assets, simplifying financial portfolio management. First, M3 asset data sets, revolutionizing asset conveyances. M3 asset data sets are comprehensive repositories tailored for M3 asset conveyances. Integrated with Banking in the Box and built on ARIS principles, these data sets promise a future where asset conveyances are simplified and efficient. First, the power of financial reporting. Financial reporting remains the cornerstone of business success. The balance sheet and income statement are fundamental in understanding a company's financial health. These reports provide insights into a company's assets, liabilities, revenues, and expenses, guiding strategic decision-making. First, the role of financial accounting software. Modern businesses are increasingly relying on financial accounting software like LoanDisk, AUS, automated underwriting software. Such software offers ease of use, efficiency, and professionalism, enabling businesses to manage their finances effectively and generate essential financial reports swiftly. First, the LoanDisk, AUS, automated underwriting software affiliate advantage. LoanDisk, AUS, automated underwriting software affiliate program offers businesses an opportunity to earn commissions through referrals while providing value to their clients through discounts. It's a mutually beneficial arrangement that enhances the business's value proposition. First, the integration of modern financial platforms. The combination of platforms like ARIS, solutions like Banking in the Box, and M3 asset data sets is reshaping the financial landscape. This integration promises a future that is more accessible, transparent, and user-friendly. First, the importance of compliance and regulation. As these financial platforms and solutions evolve, adherence to laws and regulations becomes paramount. Different jurisdictions have varied laws governing financial transactions and arbitration, making compliance crucial for businesses operating internationally. First, embracing user-friendly interfaces. The success of any digital platform lies in its user interface. Platforms like Banking in the Box emphasize user-friendliness, ensuring that users can easily navigate and manage their financial assets. First, the future of investment opportunities. With platforms like ARIS, the investment landscape is evolving. Investors now have unique opportunities to fund arbitration cases, potentially earning high returns on successful cases. First, the evolution of dispute resolution. Disputes are inevitable in the financial world. However, with clear resolution mechanisms in place, platforms like ARIS ensure that disputes are handled efficiently and transparently. Conclusion. The fusion of modern financial platforms, robust financial reporting, and comprehensive data sets is setting the stage for a new era in the world of finance. As we navigate this digital age, businesses and investors alike stand to benefit from these innovations, promising a brighter and more efficient financial future.
You hear a lot about the IMF, or International Monetary Fund, and the World Bank because they are two influential organizations that impact all of our lives. But they were created back in 1944 in response to the economic uncertainty of the times. And with so much having changed since then, what are their roles today? Are they really helping the economy? And why are they considered so controversial? Hi everyone, I'm Taylor Kenny with ITM Trading, and in order to understand what the IMF and the World Bank's roles are today and why they're so polarizing, it's important to understand how and why they were created and break down what's happened since. During the Great Depression and World War II, many countries set up restrictive trade policies that hindered economic growth. However, after the war was over, these same countries saw an opportunity to work together on a mutually beneficial system that would result in greater international trade. The only issue was that with unrestricted trade, individual economies would become more dependent on each other. With greater dependence on another country's economy came greater concerns around one nation's economy destabilizing another in the event of a recession or a natural disaster. To address this concern, 44 countries sent delegates in 1944 to the Bretton Woods Conference in Bretton Woods, New Hampshire, to create a solution. If there was ever going to be true trade, the solution had to involve stability through some kind of fixed exchange rate, but they also wanted to move away from the gold standard so they could have more flexibility, aka more government freedom to take on more debt, all in the name of stimulating their economies. At this time, the United States held the majority of the world's gold reserves, about 3/4. So that, combined with the United States' economic and political power, allowed them to propose that in lieu of the gold standard, all currencies could be tied to the U.S. dollar as a fixed exchange rate. The U.S. dollar, in turn, would be backed by gold. So any currency that was exchanged with U.S. dollar would then be exchanged with gold at a rate of $35 per ounce. And this is how the IMF was created. The International Monetary Fund would oversee the stability of the individual exchange rates, therefore guaranteeing that there would be stability in the system. And any time a country wanted to change the parity of their exchange rates, the IMF would have to be the one to approve or deny it. In addition to monitoring exchange rates, the IMF would also be the lender for any country that was experiencing a balance of payment problem. Each member of the IMF could borrow as needed, and this would ensure that interest rates wouldn't rise and trade barriers wouldn't pop up if a country's currency value suddenly got too low. At the same time, the International Bank for Reconstruction and Development, or the World Bank, or World Bank Group as they're known now, was created. To be clear too, the World Bank is not a bank. It's an organization that was originally created to help with European prosperity and rebuilding after the war. The IMF and the World Bank were created at the same time as part of one solution, but they are completely separate organizations and entities. The thought behind the World Bank creation was that if all of these countries were going to be working together and dependent on one another, they wanted to make sure that there was post-war funding available to prevent any kind of future crisis from happening. With an agreed-upon system and these organizations in place, things worked reasonably well at first. However, it wasn't too long until some issues started to pop up. The IMF struggled to keep exchange rates true. Countries who had overvalued currencies did not want to devalue their currency for fear of political repercussions, and surplus countries had no incentive to revalue their currency because they were benefiting from a trade advantage. Cut to the 1960s and we have a serious problem. The U.S. has more dollars in circulation and in global central banks that are stockpiled than the U.S. actually has gold reserves. This called into question the U.S.'s ability to actually exchange the U.S. dollars for gold, which, as you remember, was the crux of this entire system. We now know it's estimated that there were about 4 times as many U.S. dollars in circulation than there was gold reserves to back it up. So in 1971, President Nixon cut the tie between the U.S. dollar and gold, essentially ending the convertibility promise and ending the Bretton Woods system that had been in place since 1944. I promise I'm coming back to the IMF and the World Bank. Without the Bretton Woods system in place, there was less focus on individual exchange rates and more on domestic stability. Given the new floating system, you might be wondering to yourself, well, why is the IMF still here today? Because wasn't the entire purpose back when it was created in order to monitor individual exchange rates? And you wouldn't be alone in questioning that. They are now in charge of surveillance of exchange rate policies and a knight in shining armor when a country needs emergency debt assistance to get them out of a pickle. So who funds these organizations? Well, the IMF is primarily funded by quotas, essentially a subscription payment from member countries. The higher a country's wealth, the higher their quota. The higher their quota, the higher percentage of voting right or power they have within the IMF. The IMF is also responsible for creating SDRs or special drawing rights in 1969. It is not its own currency, but it is an alternative. It's basically a claim on freely usable currency of other IMF members. It's a lot to unpack. I will come back to SDRs. And when it comes to the World Bank, they also receive funding off of their member countries. And while they do 0% or low interest long-term loans, they also do regular loans and make money off of those loan interest payments. And the World Bank's goal has consistently changed well before the Bretton Woods system collapsed. Originally instated to help Europe rebuild, today their aim is to fight or end poverty. This includes everything from food, water, housing, environmental, you name it, they probably have a hand in it. There are proponents and opponents of both of these organizations, but mainly there are a lot of questions around what they do and why. It is important to note that regardless of where you fall on this, they are extremely influential when it comes to the global financial economy. I want to be fair here, so I'm going to go through both, starting with the proponents, then moving on to the opponents and controversies. The proponents will claim that many good things have happened that wouldn't have happened otherwise without the IMF and the World Bank. Some examples of success would be taking countries like Bosnia and South Korea and helping their economies and boosting them. Another example of success would be tens of thousands of roads that have been built in rural India that have helped communities have access to food, water, and help their local economies grow thanks to billions of dollars of investment from the World Bank. Now, some people question the true intention of these efforts, even if they are a success. Many wonder who they actually benefit. Are they really done just to further advance Western politics and policies? Or is it something related to infrastructure funding to help the rich get richer? Who knows? Again, these organizations are not without their fair share of controversies. The World Bank and the IMF have both been charged with policy and action that has been exploitative to poorer countries, damaging to the environment, and created a globalization mindset that makes countries think that they can fail without consequence, just to name a few. With our current globalization and debt system, there are real fears that one country's failings will have an impact on the entire system. Given this knowledge, there's a level of confidence that reckless decisions such as taking on massive amounts of debt that can't be paid back will be fine because it will just be taken care of by the IMF. This could be encouraging countries to take on more debt. Many would argue that it's better to stop intervening and let these currencies come to their true market value. Many have also said that the IMF's role is outdated and ineffective, as it's often difficult to tell if their intervention has even been positive. A perfect example of this would be Argentina, who restructured a loan with the IMF in 2018. Part of that agreement was monetary tightening to restore confidence. It actually had the opposite effect, and a serious recession followed. After lending billions of dollars with poor policy and lack of oversight, there was nothing to show for it. The wealthy took their money outside of the country at a favorable exchange rate, and Argentina was left off worse than they had been found. This resulted in an unsustainable debt burden in 2020 and riots against the IMF from civilians. Now, there are many that claim that these short-sighted monetary restrictions that come attached to these emergency loans are actually intentional. If the country fails, they'll be forced to take money or restructure loans and then have to bend to the political whims of whoever their savior is. Certain countries also have felt that they have limited influence and have been vocal about their displeasure, especially when they might be the countries who are utilizing the loans the most. This all ties into the BRICS countries, Brazil, Russia, India, China, and South Africa, who all want a bigger seat at the table and have taken matters into their own hands to find economic, stability and prosperity. There are multiple reasons that these countries feel that the World Bank and the IMF are not fair, one of them being quota and voting rights. As I mentioned earlier, the higher your quota, the higher your voting rights. So the United States holds the largest percentage of voting rights at 16.5%, which is far greater than the next largest voting right of Japan at 6.14%. We also know that BRICS countries have created their own new development bank, an alternative to the World Bank, hoping that this bank can provide loans and support without so many of these policies and strings attached that no one can make sense of. Lastly, I mentioned them earlier, but SDRs, or special drawing rights, are top of the list of concerns with the IMF. SDRs are an artificial currency instrument whose value are based on a basket of other currencies. We have a lot of questions about what is coming next with these SDRs, but the assumption is with the superpowers moving into digital currency and taking away your control over your wealth, there's a lot to be concerned about. There's a lot to unpack here, so do not fear. Next week, I will be doing a dedicated deep dive into SDRs, what they are, how they came to be, where they're going, and how you can protect yourself. I so appreciate all of you watching and learning with me. If you feel like this video wasn't enough, don't worry. We have a ton of educational videos, so please be sure to go check those out. Also, let me know what questions you have or other topics you'd be interested in seeing. I love reading all of your comments.
All right. Hopefully you guys are learning something. Special drawing rights. Riddle me this, Batman. For years, you heard me talk about, from those of you that have what we call a Moorish nationality, the only thing you should be doing when it comes to commerce is claiming a tributary tax. So here's a question. Doesn't tributary taxes fall up under FTCA or debt set off pursuant to 31 United States Code 3728? I'll repeat the question. Doesn't tributary taxes fall up under the guidelines of FTCA withholdings or debt set off pursuant to Title 31 United States Code 3728? And while you're thinking about that, let me just read this section. If the amount for fees, courts, or interest was included in the principal amount stated in line 1 as a part of a lump sum award, enter the included above. Enter included above. On lines 2 through 4, enter none for any of those principal fees and courts or interest for which no amount was awarded or included. Number 1, enter the principal amount payable excluding attorney fees, costs, and interest, and cite the legal authority for that award. For instance, FTC A, 28 United States Code 2672 or Fifth Amendment takings. Number 2, enter attorney fees payable, if any, and cite legal authority for that award. For instance, Equal Access to Justice Act, Title 28 United States Code, Section 2412, subsection B. Enter the cost payable, if any, and cite the legal authority for the award. For instance, Title 28 United States Code 2412, subsection A. If the interest was calculated by the submitting agency, enter the total amount and cite the legal authority for that award. For instance, Back Pay Act, Title 5 United States Code 5596, subsection B, subsection 2. If the judgment fund is calculated with interest, list all the dates that interest accrue starts. Total amounts should shown in the lines 1 through 4 and enter. Number 6, enter any deductions specified in the judgment or settlement agreement or debts to be set off under Title 31, subsection United States Code 3728. Indicate the reason for the deduction, for instance, such as FTCA withholdings or debt set off pursuant to Title 31, subsection United States Code, subsection 3728. And the payees agencies, and ALC. If this deduction is a debt set off pursuant to Title 31 United States Code 3728, you must attach a copy of the judgment and plaintiff's agreement to the debt set off. Otherwise, FS must seek the claimant's consent to set off and may only withhold from the payment an amount sufficient to the debt plus the cost of litigants. Litigation will be required to effect the set off if there is no judgment of debt or if the claimant declines consent to set off. If there are more than 3 deductions, attach additional copies to this form, and if there are no deductions, enter none. Here's the money shot. Administrative debts that have been certified to the Secretary of Treasury through the Treasury Offset Program will be set off automatically. Total amounts shown on all columns, line 6, subsection A, B, and C, and entered. Number 8, subtract the amount in line 7 from 5. If greater than 0, enter the difference. If the difference is 0 or less, enter none. They're referring to all this up here. I've read that for some of you guys that already have Bank in the Box, and you know why I read that. But for new people, I need some questions. Because, see, I asked the question earlier, doesn't tributary taxes fall within the FTCA withholdings and debt set off pursuant to Title 31 United States Code 3728? And let me just go and see if anybody had a chance to answer that inside the chat. I'm checking the chat. I don't see nothing in the chat. I don't see no questions pertaining to what I just asked. And at this moment, I don't know whether I should keep going or just stop and see if everybody's clear. I think I'll just stop and see if everybody's clear. Please press 9 on your keypad if you got any questions, comments, or concerns or anything that you have heard up until this point. Any questions pertaining to what we have discussed? Any questions? I'm either doing a great job or folks are just afraid to get on the mic. Any questions, comments, or concerns over anything we discussed up until this point? Thank you. Brother Hunter, talk to me.
Hey, what up?
What's good? Talk to me, man. Talk to me.
Okay, so I was just chat running around. In this sense, we're talking about that we're this conjunction with that because already validating without them never being the trust the door. Violation, right? That's what I'm saying. So when we're going, that will be for by.
Okay, your phone was coming. Right. Let me switch the mic because I'm hearing every other word, and I think you might be on a speaker or something like that, and I'm hearing every other word. So bear with me while I change this up because I couldn't hear a lot of what you just said. So hold on. Let me get this right because I want to make sure I'm answering your question to the best of my ability. All right. Let's see here. Hold on. Bear with me. Let me tab here. Where's the mic? All right. Okay. Now ask that question one more time.
You can hear me now?
Yeah. Go ahead.
Okay. Well, I don't think it was more so of a question about them violating from the jump. I ain't want to go through the whole scenario again, but they violating from the jump with them being trustees of, well, I would say more, but.
Right. From a Morse perspective, you have to understand that the government, the said government, the state government, the local government, the federal government, these are all occupiers. They're there by occupation. They can't use the Morse names in their position of status, so they're there collecting a tax on behalf of the estate. So a Moore could proclaim that this tributary tax fall within the guidelines of FTCA withholding.
Exactly.
The Constitution
Okay.
merits
So
that. This, and again, I brought this up so for new individuals, especially those that come from a Moorish paradigm, will understand where Bezel Bay gets on and get off at. When I first understood the plight of the melanated quote unquote man and or woman, and when it came to this whole secured party creditor proponent, which is dead on and right, I told individuals who were actually standing in their Moorish appellation, why don't you claim a tax that's owed to the estate and get out of everybody's way? Because the system is already set up for that. And it's rigged if you're making such claims and not going into that. Which, since you brought it up, Brother Bay, it will be to every Moor's advantage to explore all of those statutes that I listed when I read down the line on the judgment affidavit. Because if you have a nationality, maybe those things may apply. If you have a nationality, maybe those things don't apply. Who am I to say which way or the other? But I can say that since civics talks about law and history together, once you know the law and history, you know exactly administratively where you should be in this complex, system. I haven't met a Moor as of yet that has, without a doubt, debated the fact that, yeah, we're owed a tributary tax. My question is like, okay, why haven't you claimed it? I mean, like, I'm not the only one on the planet that has claimed a tributary tax. Surely not the only one on the planet that's done that. Oh, I get it. It's not popular. You can't sell paperwork packages. I don't have a dog in that fight. I'm saying there's a form for everything. The accounting allows you. Did you hear what Brother Han was saying at the beginning of the class about being able to roll back the financials to incorporate those losses? You can roll back the clock. If you see that there is any type of digital footprint in the DTC or DTCC system, that's where you start your accounting from that aspect and then roll it forward. What do you think they're getting the value for these securities that they're selling across the planet anyway? And America's not the only country that's monetizing their citizens. Surely y'all don't think that, do you?
of course not. They all are the same. The reflection
right.
of each other.
Right. So for those that have left Africa and became an American, those that left America and became an African, vice versa, doesn't matter. You still are playing the same game. It's a tributary tax.
So, question. So, with the securitization audit that we're doing, wouldn't that be capturing all that glamour?
Exactly. That's why we go tick for tack. That's why when you go before those notaries, they're going to address through attestation and jurating what your status is. Like, we ain't going to guess that you're the public or the private. We going to have you on the record state what you is, what you isn't. So that way you'll know which way the securitization is supposed to go. Because there's a path for the public and there's a path for the private. And it ain't about what you tell me, it's about what you do that determines who you are. Now, because I know you're more...
That would be on the same footnote. Like I see a lot of guys go down and get their things recorded with the county or with, how...
The counties are ancient, yes.
Yeah, they are ancient, of course. But I just look at it more so if we're building a platform like this right now, with we not figuring out who the law is here.
Right. It's very easy for a lot of individuals to get into a penis measuring contest when it's not about that. It's real simple. If you start an LLC and you're not taking advantage of current expected credit loss provisions, there is a form for you to fill out. If you woke up yesterday because the day before someone hit you over the information that you're ready to go, quote unquote, become sovereign and operate in accordance with blah, 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 what are they telling you? State your legal authority in this judgment against the United States. The United States owes debts, but they have credit from its citizens. So everybody who is refusing to take a nationality now becomes the insurance for your reinsurance. It's not personal. It's not personal.
So in turn, the standard form for this administrating claim under the Federal Tort Claim Act.
Insurance. Here's a form. If you can see my screen, I'm gonna show you a form. If you can see my screen, let me change my algorithm here. I'm gonna stop the share. Okay, we got a form 75. Let's go form 75 here. Here's a form. Here's a form you can use. An Accord Form 75. This form right here is one of the forms you fill out. Form 75. And then when you're ready to petition it another way, you'll fill out this general liability notice of occurrence and claim. One gonna put it in. One gonna put it.
You're saying okay. Go ahead.
One puts it in. The other takes it out.
Gotcha.
Hopefully it's starting to make a little sense to you, especially when you start associating this insurance, reinsurance. They got a whole coding system with the Treasury. And as I'm scrolling down the form, the securitization audit is going to help you fill in these blanks. There's your payment voucher. Your audit is going to help you fill in these blanks. Then it's just a matter of utilizing the payment guarantee, processing instructions, your medallion signature guarantee. Remember, there's a bill of exchange for the DTCC, and there's a bill of exchange for the DTC. Whatever you do on one side, it's got to be an equal and opposite on the other.
So that form also will be ran by the ARIS.
Exactly. That's why when you go through your securitization audit, this form is what we're going to be discussing in the aspect of what goes where. Now, I just can't pre-fill it out. I have to make sure you understand who you are in the transaction. It's making more sense to you.
Yes.
Beautiful. Beautiful.
That cleared it up real good.
All right. Any other questions for me?
So now, the 8302, wouldn't we be doing that as a tributary tax also?
There you go. You got to prime the pump.
Gotcha.
You must prime the pump.
All right, that's it for me right now.
All right. Appreciate it. All right, any other questions for anyone pertaining to what you have listened to, heard up until this point? Please press 9 on your keypad so that I may address that. Any questions, comments, or concerns of anything we discussed up until this point? Press 9-4 on your keypad. Okay. Well, I did such a good job. No questions. Well, with that being said, and I'm going to stop while I'm ahead. I appreciate everybody's time and energy. If you keep listening, you definitely will learn something. This class will be recorded. It is being recorded and will be made available within the next 5 to 10 minutes. With that, I'm going to say peace and love, family. Peace and love.